Welcome to Passive Income from Equities, my new channel. Hi, my name is Skip Kapoor, and we're going to talk about SCHD, Quality Dividend Growth ETF, my largest holding. And we'll talk about three or four things. One is some basics and details about the fund, the methodology, which is probably its strongest point. We'll compare it to other competing ETFs. And lastly, we'll discuss where it makes sense to own it. And the style of investing that I practice is called enhanced equity income. That is getting more income from equities. Let's cover some of the most basic information about SCHD. First is based on an index called the Dow Jones US Dividend 100 Index. We'll go over the details in subsequent slides, but it's a very powerful methodology and one of the most attractive aspects of this ETF. It's cheap at 6 basis points and highly liquid with $54 billion in assets and is provided by Schwab, very good brand in my view. Let's get a sense for the holdings. The top 10 holdings are Cisco, Texas Instruments, Chevron, Home Depot, Amgen, Lockheed Martin, BlackRock, Verizon, Coca-Cola, and AbbVie. All quality companies by any stretch of the imagination. And if you look at uh, the strength, the business model strength, Morningstar has a moat rating. 8 of the 10 have wide moat ratings and 2 have narrow moat ratings. So it's 100% of the top 10 holdings, which are about 40% or so of the entire portfolio, have moat ratings from Morningstar. Part of the methodology is to cap individual holdings at 4%, and sector cap is at 25%. We'll talk about that a little bit later. It's reconstituted annually. Uh, you'll see why that's a strength a little bit later, and it's rebalanced quarterly. So what that means is if Cisco goes above 4%, it is brought down to 4%, and that the gains are invested in other holdings which have gone below the 4% level. So you're basically selling expensive and buying cheap. Its total performance is more than acceptable. So $10,000 in October 2011, when the fund was uh, created, would have been a quadruple by July 6th of this year. It is about 200 basis points per year less than SPY, the S&P 500, which is the benchmark for all my holdings, and what I recommend all investments should be benchmarked against, because SPY can be bought by anybody very easily. So it's a significant difference, and it also explains why it's very difficult for any investment to beat the S&P 500. It yields as of uh, July 6th at a cost, if SCHD's cost is $77.24, is yielding 3.68, and all the dividends are qualified because it holds no REITs. It's the only sector in the S&P 500 that it does not own. Now this is worth stressing. SCHD has increased payout every year since inception. What that means is that the dividends, the actual cash being provided to shareholders by SCHD has increased every single year. To the best of my knowledge, this is the only dividend or dividend growth ETF that has done so. Its payout has increased at about 11% per year over the last 10 years, so it's clearly beaten inflation. Um, the most recent distribution was the largest ever at about 82 cents per share. Um, I hold it because it's a counterweight to the S&P 500, right? It's the anti technology, or at least the anti high flying technology emphasis that pretty much defines Standard & Poor's 500. And lastly, there is an international version of SCHD, exact same methodology, but it only holds international companies in developed markets only, which I find attractive. So that's a brief summary of some of the crucial aspects of SCHD. So I just stated that SCHD is a counterweight to the S&P 500, and one of the reasons I own it. So what does that mean? Well, 44 of the 100 companies held by SCHD are in the SPY, in the S&P 500, and only 8% by market cap, right? So yes, it's definitely influenced by the S&P 500, and it may even move quite a bit in tandem with the S&P 500, but it will give you benefits of diversification. Let's talk about performance. So the annualized return over 10 years I got the information from Portfolio Visualizer. It's about 10.8%. Standard deviation is 15%. That's volatility. The max drawdown in any year, the worst year was 21.5%, and $10,000 invested in January 2015 would be 26,000. The Sortino ratio is a ratio that measures volatility only for um, down markets. Higher scores are better. So it's got a Sortino of 1.06 and it yields 3.68. If you compare that to the S&P 500 as the vehicle being SPY, SPY outperforms an annualized return, not much difference in standard deviation, not a significant difference in drawdown, higher returns, higher Sortino, much lower yield. So the picture becomes very clear. Very, very difficult, if not impossible, to beat the S&P 500. In my view, cannot be done. So the reason to hold SCHD is diversification and because you need higher yield. If you did a 50-50 portfolio of SCHD and SPY, you would get returns in between, and frankly, it would outperform SCHD but with a lower yield, as you can see. So bottom line, S&P 500 outperforms, and the reasons to own SCHD, they have to be strategic. And in my case, they're because I need yield, because I'm at the living off my nest egg phase of my life, and because of tax efficiency, qualified dividends, and because of the benefits of diversification. Let's discuss the methodology behind SCHD, the Dow Jones US Dividend 100, which is the strongest uh, dimension, and why I think is better than every other dividend ETF out there. So we'll cover the selection process. So the very first step is they have a screen for both yield and liquidity. And what they do is they take every company in the US universe, all non-REIT, and they exclude REITs, and they look for three things: a minimum of 10 consecutive years of dividend payments, not 10 increasing years of dividend payments, but just 10 consecutive years of dividend payments. They look for a market cap minimum of about $500 million and daily trading volume of $2 million per day. And what they're looking for is liquidity and a certain size, right? So of the about 2,500 plus companies that are non-REITs, about 450 companies make it through this initial basic screen. So then what they do is they eliminate the bottom half simply based on yield. So now you're down to about 225 companies. Then they create a composite score of the following four: free cash flow to debt, and free cash flow is cash left over after normal capex. Return on equity is net income divided by equity. Yield is the yield from the dividend distribution. And then they look at the 5-year dividend growth rate. So this is the first time they're looking at dividend growth. And about 225 companies enter this process, and they only select 100. And the kind of one thing to know is that if a company already exists in the index, because this process is run every year, once a year. So that's the reconstitution every year process. So if a company already exists in the top 200, it will stay I consider that probably a strength because they're allowing the company to continue to perform. And if two companies have the exact same composite score, the one with the higher yield is selected. Let's delve a little bit further as to why I think the methodology is so strong. And the companies that make it through the steps I just walked you through tend to be strong companies, mature companies. They're not in early phase. They're throwing off lots and lots of cash, and they're shareholder friendly because they're actually sharing some of the cash that they're throwing off with the holders of their shares. So let's talk about two metrics, two out of the four that make up the composite score, and see how synergistic they are, right? So the first one is return on equity, which is net income divided by average shareholder equity. Equity obviously is a liability on the balance sheet, just like debt. And so ROE, the metric, can be increased by increasing debt and reducing equity, right? So this table shows you assets and liabilities. On the liability side, you'll see debt and shareholder equity. So if you have a lot of debt, you're going to have less shareholder equity in terms of dollar amounts. And so if you divide net income by a smaller number, you're going to have high ROE, right? So it could be a way to game the system, if you will, or have a highly leveraged balance sheet. The second metric is the sophistication, right? So what it does is it looks at free cash flow over debt, and free cash flow, as I said previously, is all cash left over after normal capex. It's genuinely cash that the company can do anything with, and the usual uses of that cash is either paying off debt, strengthening the balance sheet by storing cash, buying back shares, or acquisitions, which usually lead to trouble. So what happens is that if you have a lot of debt and not enough cash flow, this second metric catches that. So companies that make it through both of these met, 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 metrics tend to be ones which are balanced between the use of debt, shareholder equity, and the amount of free cash flow that they are generating. The last two metrics of the four that make up the composite score are actually both simple and powerful. So by looking at companies with the highest 5-year dividend growth rate, you are uh, going after companies that are showing strength in being able to pass on more and more cash back to shareholders year over year. And then the yield criteria simply make sure that the overall yield from each company and therefore the overall ETF is competitive. And you will see that when I do the comparison that SCHD tends to hold a powerful list of companies, 100, and also be at the higher end of yield for dividend ETFs. We'll go through some comparisons. First, I'll compare SCHD to SPY, the S&P 500. Um, pretty straightforward. SPY, in my view, cannot be beat. This is since inception, and the data is all the data here, and then subsequent slides are from Dividend Channel. There's about almost a 200 basis points difference in annualized average total return. It's not inconsequential. So if you had $10,000 invested at inception, you would have had about 44,487 with SCHD and almost $10,000, actually slightly more than $10,000 more, if not 11,000 with the S&P 500. The only area that SCHD outperforms is in yield, 3.68 versus 1.23%. Let's now look at matching SCHD against some of the well-known dividend ETFs. And if you look at VIG's inception date is earlier than 2011. So this is from SCHD's inception date. The performance is actually, the total return performance is very, very even with SCHD slightly ahead, not materially, 44,400 versus 44,100 if you had invested $10,000 on October 24th, 2011 when SCHD was uh, had its inception. So similar performance, but much higher yield, 3.68 versus 1.82. A quick look at VIG, which is a very, very well-known ETF. It's from Vanguard. It has a similar expense ratio to SCHD, large fund, $93 billion in assets, many more companies, 339 companies versus 100 for SCHD. Its largest holding is Apple at 4.17%. I just wanted you to get a sense for its largest holding. It's based on an index called the S&P US Dividend Growth Index, and the thrust of the index is what they look for is 10 years of dividend growth. So all the companies have 10 years of dividend growth, and they remove the top 25% yielding companies. And the reason for that is they remove dividend traps, as they're called. Weak companies on their way out. The market is punishing their stock price, and therefore the yield is very high. So they remove those, which is why a company like Apple can become its top holding. Next, we'll compare SCHD to VYM, another very well-known dividend ETF. And here, SCHD is both outperforming VYM and also providing a higher yield. So again, from inception date of October 24th, 2011, SCHD would have given a total return close to 44,200 versus 40,300. It's not material, but it's a little bit meaningful, right? A 4 grand is 4 grand. Let's talk about the methodology difference. It's from Vanguard again, 6 basis points, 66 billion in assets, so it's highly liquid, large, very large number of holdings, 556. His largest holding is JP Morgan at 3.53% of the portfolio. It's based on an index called the FTSE High Dividend Yield Index, which excludes REITs just like SCHD does. And the methodology is that they look at only qualified dividends, which is why they excluded REITs to begin with. They have this kind of formula for where they forecast dividends over the next 12 months. It's kind of a proprietary thing that they do. So they look at all the companies, they forecast the dividend yield of for the next 12 months, and they select the top 45% and they exclude the bottom 55%. So the yield is higher than VIG, but not as high as SCHD. So SCHD is outperforming in total return and in yield. We'll now look at SCHD versus Noble, NOBL, a dividend aristocrat ETF, classic. A lot of people know about it. And bottom line, SCHD outperforms NOBL both in total return and in yield. This comparison is from Noble's inception date, which is after SCHD's on October 10th, 2013. But essentially, $10,000 would have gotten you 32,000 with SCHD, 28,800 with Noble. The yield difference is, over 1.4%, so meaningful in both cases, I would imagine. Noble is provided by ProShares, a good company. Higher expense ratio, 35 basis points, so that is definitely not going to help. That's a drag. Reasonable assets under management, 11 billion, 66 holdings. The minimum number of holdings is going to be 40, so there's 66. The largest holding is C.H. Robinson Worldwide, a logistics firm, very high quality company at 1.93%. So that tells you that this is not a concentrated portfolio, which is a good thing. It's based on an index called the S&P 500 Dividend Aristocrats Index. So every company here is within the S&P 500. And the methodology is extremely straightforward and quite powerful. Has to be an S&P 500 company, and it better have 25 years plus of dividend growth. We'll now look at SCHD versus DGRO. And bottom line is DGRO, which had a later inception date, so this comparison is from DGRO's inception date, has a non-material outperformance, 29,400 versus 28,200. if you had an initial investment of 10,000 in both funds. So it's non-material, but the yield is obviously higher with SCHD at 3.68 to 2.36. It's about 140 basis points or so. DGRO is provided by iShares from BlackRock. Very reasonable expense ratio of 8 basis points, large and liquid at 27 billion in assets under management. A lot of holdings at 412. You'll see why when you look at the methodology. The largest holding is JP Morgan at 3.11%, which means probably the top 10 holdings are going to be probably in the 25 to 35% range. It follows an index called Morningstar US Dividend Growth Index. Morningstar is a very reputable company. And the methodology is quite straightforward. They only look at companies which give qualified dividends, and they look at every company that, in addition to that, has the highest 5-year dividend growth and an earnings payout ratio less than 75%, right? So they want to make sure that there's enough, there's a difference in the amount of cash being generated and the amount of cash being sent to shareholders. And that pretty much, this criteria pretty much tells you how about 412 out of the 2,500 plus companies make it through the screen. If we look at a summary view for the last 10 years, which is the max I could get from Portfolio Visualizer, you'll see that a $10,000 investment, the results of on each of the ETFs being compared on total return, the S&P 500 is the highest, which obviously means that the annualized return, the S&P 500 is the highest. Standard deviation is also the highest, which is not a good thing. The lowest is with VIG, but is any of this material in standard deviation? I don't think so. Max drawdown, which is the worst year performance, again not a material difference. Sortino, not necessarily a material difference. VYM probably is kind of an outlier in a negative way in terms of Sortino. And Sortino again is the volatility in down markets when it really matters, when it really hurts as an investor. So Sortino is a good thing to keep an eye on. Correlation to the benchmark, not a material difference. Yield, I would say material difference. SCHD is clearly outperforming in that. And which quite frankly brings me to the bottom line that if, and this is a big if, you are wanting to balance your portfolio and you want a dividend holding or a dividend growth holding, a very convincing case can be made for SCHD on two bases. Quality, because I consider the methodology far more sophisticated than any other one that I compared it to, and then yield, which the data demonstrates that they do a good job with. And it also, the second point that should jump out is why the S&P 500 is a terrific investment and should probably be the backbone of most people's 401k and IRAs during their working years. And that certainly was the case with me for the 30 years or so that I spent working in the corporate world. And the reason for it is essentially market wisdom at work. And the second reason is that 4% of companies tend to provide most of the returns. The 4% of companies that do so keep changing, and it's very difficult to know about them in advance. And the only way you know about it is when it's usually too late. So in other words, very few companies provide most of the returns, and as an individual investor, it's very difficult to know about them in advance. Whereas the S&P 500 selects those companies automatically because as shareholders discover the value of these companies, the market cap goes up, it goes into the 500, and the weaker companies come out, which is why it is virtually impossible to beat the S&P 500. So I keep mentioning the quality of SCHD. Let's take a look at the sector diversification, right? So there are 10 sectors in play. The 11th sector, REITs, are excluded by definition, right? So let's take a look at the largest holdings in each sector. So in financials, BlackRock in US Bancorp. In healthcare, Amgen, AbbVie, Pfizer, and Bristol Myers Squibb. They are literally the only four companies held in healthcare. Consumer defensive, Coke, Pepsi, Altria, the tobacco company. In industrials, Lockheed Martin, United Parcel Service. In energy, uh, Chevron. In consumer cyclicals, Home Depot is the largest holding. In technology, it's Texas Instruments and Cisco, not bad. In communication, Verizon. In basic materials, Lindell Basel, the chemical company. And in utilities, a company called Clearway, which is a green energy type of company, clearly with strong financials to have made it through the criteria. But you can look at these companies and you get a sense for very strong and a reasonable amount of diversification. If there's anything I probably don't feel very comfortable with is the large percentage in financials. And there's a large number of holdings in financials. A lot of them are small cap financial banks and so on and so forth. They're probably extremely well capitalized and profitable, otherwise they won't make it through the criteria. But that's about the only thing that I feel a little bit nervous about. But the long-term record of SCHD's performance gives me comfort, and it's not something I'm terribly worried about. So here's the bottom line regarding SCHD as far as I'm concerned. First, it's a counterbalance to my S&P 500 and Nasdaq 100 based ETF. So my entire portfolio, which I covered in the design and details of a passive income portfolio, that's a three-part presentation that's available. Um, SCHD is one of the four ETFs that make up a base and the anti S&P 500, if you will. So it's subperforming S&P 500 in total return terms, but giving the benefits of diversification with very different types of holdings. And it's an excellent balance of total return yield and dividend growth, as I demonstrated with the comparative data. And it clearly uses powerful and synergistic factors. The synergistic factors that I shared were the cumulative impact of the ROE metric and the free cash flow to debt. That shows a tremendous amount of sophistication. It's my preferred dividend growth ETF and the only one I own in this category. In my again, referring back to my other presentation, the design and details of a passive income portfolio, there are six components to an enhanced equity income strategy. Dividend is one of the six, and in that, this is the only ETF that has made it through my criteria. It's my largest holding, and my target allocation is 15%. The actual allocation today, as I speak, on July 8th, 2024, is higher. And the reason is that it's an ETF where when the yield gets above 4%, I actually add, and then I lighten up when yields go down below 3%. So my actual is higher than my target, and it's a temporary situation. During my entire adult life, from the age of 24, I'm 65 today, I've always owned dividend growth companies, typically in my taxable accounts. And if I had to do it all over again, I probably would use SCHD instead of buying individual dividend growth companies like I used to. It's less work, better performance. And this next thing is something I urge each of you viewers to consider. Always make investment decisions vis-a-vis your strategy. So in my case, this is appropriate for me because I'm in the living off nest egg stage of investing. Having said that, you must know that I have a income bias. I want to get paid from my investments because that's how I see an asset, and that's how it's been defined by Warren Buffett, who I consider one of my investing mentors. So I would have owned dividend growth companies or ETFs no matter what, and I acknowledge that I have that bias. And given both the things, my bias and where I am in the phase of my life, SCHD is a pretty good holding to have. So as we come to the end of this discussion, this presentation, I'll just remind you that success is the sum of small efforts repeated day in and day out, right? We want to get better from a health perspective, start off small. Want to eat better, start off small. Same thing with investing. So I urge you to get started on your investing journey today after having done adequate research, due diligence, and documenting your strategy. I'm sharing my journey and everything I know because I've learned from others. And so all my knowledge is from other people and I'm just paying it forward. Always do your own due diligence. Never blindly follow somebody else's strategy or framework. Use information as in presentations like this for triangulation, for making up your own mind as input into your process, but don't copy it blindly. This is my third video. I would appreciate any feedback in the comments. And the main thing is it'll help me provide better product. And I would like to thank Gayatri, my life partner, for being my partner in every endeavor and being my editor and supporting me in other ways in this YouTube journey. Thank you, and all the best.